Hello there. Welcome to another episode of Between Two Daves. I've got our Chief Investment Officer, David Nolan, and our CEO and President, David McKinley, joining us again. Thank you, gentlemen, for your time. Would love to dive into a few things that may be top of mind for you that might be useful for others to be contemplating. And without further ado, I'd love to get your thoughts on recent market volatility and how our approach may be helpful to others.
Sure. Lots to cover. It's been an interesting last couple of months.
Yeah, it's been, these are interesting times. Just today, we've seen this tremendous market reaction, just as we saw when there was a 90-day extension on the first round of tariffs. So it just shows you that we talk about how the risk here over the last month have gone more to the upside than the downside, because every time there's a bit of positive news, the markets elevate pretty significantly. So it just goes to this whole issue of those that try to spend a lot of time on market timing. It's rarely successful, and this is just another perfect example. Over the weekend, developments on the China tariffs being dropped dramatically by both the Chinese and the Trump administration, and so now we have a situation where the market is back to what is referred to as risk on, which means that people are now willing to put money. They've lessened their concern about the negatives, and they're focused solely on the positives. So this is just another lesson on, and Jay, we've talked about this before, this issue of, things are not different now. Human psychology, really doesn't change. You think about the last two times we've seen massive volatility of this measure, it was at COVID, and that turned out to be a great buying opportunity. And then when the first tariffs were announced, and then the market went down shortly, and massive volatility. So historically, if you take advantage of it, then the fundamentals of the U.S. economy are so strong that it tends to recover quickly.
I interject a quick point though on that. I think it has a lot to do with the individual person's situation. How much risk can they tolerate? How much time do they have to ride through periods of volatility like this? Because it's an amazing opportunity for many, and the worst possibility for others. I think the individual situation is very important to understand. I really pride ourselves on taking the time to get to know the individual client and understanding their risk tolerance. Who would have known that this year international equities would be up 12% year to date? I mean, holy smokes, amazing numbers.
Yeah, I think to speak to your point, one thing that we emphasize here is the difference between someone's ability to take on risk and their willingness to take on risk. Mm-hmm. Two very different equations there. And as we think about previous market volatility and how that relates to typical or average intra-year declines, how would you all assess this, what we've experienced over the last 6 to 8 weeks in relation to long-term outlook of the U.S. economy?
David, you got to use your Rip Van Winkle example.
The Rip Van Winkle.
You fell asleep for a month or two. Did anything really happen? Well, yes, right. It did.
Yeah, it's a Rip Van Winkle, or if you've been on the moon and you didn't have access to what was going on, you came back and you said, well, it doesn't look like it's been very exciting. Looks like it's been pretty boring, but we know what's been going on underneath the surface. And so sometimes when we discourage clients from focusing on the day-to-day. There are some people that's in their nature that they're going to check their account every single day, because now electronically you can do that. And that sometimes leads to really bad decisions, because when things are bad, people extrapolate a current bad environment to that's what's going to keep on happening. Just as when things are fantastic, they extrapolate that to say things are going to continue to be great. And you really, in many cases, you want to do the opposite of what your emotions are telling you to do.
Could not agree more.
Yeah, and not that we tend to be automatically contrarians, but it is interesting that one of the things that we continuously see are, as you mentioned, tend to be focusing on the micro when we can zoom out and look at patterns, see the 10 to 20 year averages, and think about that in terms of, especially with how market cycles operate nowadays. We see all this market activity happening, and sometimes we fail to remember that market cycles are so compressed. Things that used to take months and years to play out in the market just a few decades ago now can take days and weeks. And a lot of that trading can be and information can be overwhelming to process, especially if folks are trying to do that on their own.
Well, I believe there's an old Ben Graham quote about in the short term, the market is a voting machine, but in the long term, it's a weighing machine. So that's what you see with emotions. People are watching TV, they're reading, and they get hung up on the short term, and they'll make decisions and remember, we've told folks that when you make a decision to be particularly negative and you sell, that's a two decision issue going forward, because you've made that decision, and now you've got to determine what's the trigger to get you back in. And most people won't get back in when the market starts to feel better, because they're thinking, well, it's a trick, it's a head fake, and it's going to go back down. So ultimately, they wait till the market has some huge run, and then they sort of capitulate in the other direction, which was really against their better interest.
Sold low and bought high. I'm pretty sure it's the opposite of what we should be doing, right?
Yes. And then and Jay, your point earlier in terms of what history tells us. In fact, we actually have a great chart that shows that the average decline from the high during the course of the year has been for years about 14%. And this year we had a drop in the S&P of about 19%, and then it's recouped a huge amount of that. And this is normal. Human emotions don't change. It's been the same for years. And I've said for quite some time, the American economy is an amazing vehicle in that once it understands what the rules are, then it can adjust and do quite well. It just needs to know what the rules are.
Yeah, and as much as we would certainly like to be living in precedented times, it's obviously new information that is being made available, and the market tends to adjust for that. And that's one of the reasons why we build diversified portfolios the way that we do, including international allocation, which to your point earlier has done very well and has been a great buoy for our client portfolios year to date. Any other parting thoughts or anything top of mind for you that you feel like would be worthy of mentioning here today?
I reflect on the last of these that we had. We talked a bit around the outlook for tariffs and global trade, and I continue to believe that the plan A is to do away with virtually all tariffs against us and by us, and that it could very well lead to much more open trade. I think that could be just phenomenal for our economy, trading with hundreds of millions in the middle class and higher in China or India. I can't wait to see, I'm anxious, but you can't wait to see what it looks like at the end of the 90 days. What do we have? Another 2 or 3 weeks, I believe, right? Wasn't it? No, well, I'm sorry, it'd be the first week of July.
Yeah,
sorry, I'm off by a month.
And then we have with China, we have a new set of 90 days. But in the meantime, too, what's going to be happening is there's going to be conversations happening. And so there's nothing magical that happens at the end of 90 days, because many of these things will be worked out well in advance of that 90 days. So it's where you say you have to stay tuned because there's a lot of developments that happen almost on a daily basis. And but we just tell people, our big focus is the three legs of the investment stool: inflation, interest rates, and earnings. Those are what drive markets. And as long as those are intact and we feel good about them, we feel good about the overall market.
Absolutely. Well, thank you for your time, gentlemen. I believe that closes us out on another episode of Between Two Daves.
Thanks for having us, Jay.
Thank you, Jay.
Take care.